All right, 3 minutes to go for the pre-open session, and the SGX is indicating a super strong start once again, 150 points or so. Ashish Chaturmota is Director and Head of Research at JM Financial. Is joining us now. Ashish, good to have you with us here, as always. Thank you very much. So we are again going to knock at that important trend line from all-time highs, and the momentum just seems pretty strong. Your sense, and what would you advise viewers to do?
Good morning, Prashant. So I think, broadly markets are consolidating after testing almost 18,200 kind of trajectory. And since then, we have seen some correction. But broadly, we believe 17,400, 17,500 is going to be a very, very strong support zone. Looking into the options data also, there is a lot of put writing, which is happening around 17,400, 500 trajectory. But I think the real strength we are going to witness in the bank Nifty. So I think that's going to lead the entire pack, because there we are witnessing a very good trend. If you look at a comparison, Nifty is still 5% away from its previous all-time high, whereas Bank Nifty has almost tested the previous all-time high made in October 2021. So which clearly indicates this outperformance which Bank Nifty is trying to indicate in the last 3-4 months time frame is going to continue, and we firmly believe 43,000, 44,000 is what one can expect in Bank Nifty in days to come. In terms of individual picks, my first pick again from a banking basket would be Axis Bank. I think this stock has been consolidating for a good 6 months time frame, and now we are seeing a lot of build up in terms of OI addition, clearly indicating long accumulation happening into the stock. So with 785 as a trading stop loss, one can initiate long positions in Axis Bank. In an immediate short term, 850 would be my target, but positionally it looks like stock is poised for a move beyond 900 kind of trajectory. Second long call would be on Adani Ports, again stock which we have been recommending since 825 or trajectory. The way stock is seeing a buildup of long positions both in the derivative segment, as well as a lot of cash positions is also getting, delivery volume is also picking up in the stock. Stock has been consolidating for good 18 months, and now this is a fresh breakout in Adani Ports. So one can initiate a long. 945 would be my trading stop loss. 1050 would be my short-term target in Adani Ports. In the cement basket, ACC I think has hit a fresh all-time high, and now 3 days consolidation looks like stock is poised for a fresh rally. 2580 would be my trading stop loss on upside. 2800 would be my short-term target in ACC. And last but not the least is the entire auto basket. And within that, Maruti is our preferred bet. We believe that this is a very strong structural story which is playing out in Maruti. So at current levels, 9100 would be my trading stop loss. 9700 would be my immediate short-term target in Maruti.
Okay, thanks a lot for that, Ashish. Have a great day. Maruti, in fact, hit a fresh 52-week high yesterday as well. This entire space has been really active. But the sector that we're going to talk about over the next 5-10 minutes, and we have been talking about it for a while, is cement, right? With the Adanis investing, what, $2.5 billion into the cement space. The industry dynamics are definitely going to change. Dipan Mehta is still with us, and in a bit we'll get another expert on that. Dipan, you briefly mentioned what one should be doing with Ambuja, etc. But what about the other cement players, right? Industry dynamics will change. There will be perhaps a lot of inorganic moves as well from the larger guys. So what do you do with names like, say, an India Cement, something like a Nuvoco, Shree Cements? If you are investors in these stocks, what's the way forward?
I think you can remain invested because of the way Ambuja ACC stocks are moved up. The sector as a whole is getting a higher P multiple. And Sonia, I wouldn't bet on too much of consolidation. I think look at the players which are there in the cement industry. They're all very strong players, deep rooted. They do not want to exit this business per se. It's a good money, cash flow generating operation for them. So I wouldn't bet too much on consolidation. But the way the capacities are coming up within the sector, that certainly is a cause for concern, because you could soon have a situation where the pricing discipline which they have maintained for so many years, that could get vitiated, and that will have a direct impact on the operating profit margins of these companies. And it's not that cement companies are trading at the cheap valuations. These are all going at PEGs in excess of 3 times or so. So that's the main reason for my caution at this point of time. But there is momentum, and momentum can take these stocks higher, but it's just that I'm not participating on the trading or investment side in cement stocks per se.
Okay, Deepan, you might want to hear this next conversation as well. Pinakin Parikh is Executive Director, Metals and Mining, Oil and Gas, Cement at JP Morgan India, and he's joining us from the sidelines. of the JP Morgan India Investors Summit. Pinakin, great to have you on the channel. Great to have you on the program. Thanks very much for your time. Prashant this side. Let's just start with exactly that, cement. The big announcement from Ambuja. What do you think it means for the sector? Are we going to see a lot of organic capacity in your expectations, or will we see them buying up a lot of existing capacities from companies already listed? What's your sense, and what does it mean for the sector and investors?
Sure. Good morning, Prashant. So, clearly cement is right now in the news flow. We would not talk about individual specific companies, but what the markets seem to be pricing in at this point of time is a wave of consolidation. We have seen cement stocks across the board move higher. Every cement stock is trading at near lifetime high EV/EBITDA multiples or an EV per ton multiple. So, it's asset-based or earnings-based. Historically, what we would point out is that most of the times that cement assets have changed hands, they have taken place when there has been distress in the industry, there has been leverage in the companies, and the NCLT process accelerated that process. At this point of time, if you look at the listed universe, there is very little leverage across most cement companies. So there is no stress. Having said this, we don't know who could be the potential sellers. What we would point out is that unlike other industries, cement does not demand a lot of capex on a run rate basis. You set up a plant and then you have an annuity cash flows. So one also needs to keep that into account, that if you do not have leverage on your balance sheet and you have an annuity cash flows, are they enough willing sellers to go around even if there are buyers at a certain price?
Okay, Pinakin, good morning. So, just to carry forward that point, because we are having this conversation with the Shree Cement MD as well. He said, look, we are in the market, but the problem is that almost everything has gone up so much. So, and the market's bidding every cement stock as if it's going to be bought over tomorrow, maybe by Adani, right? So, is there a bit of a bubble being formed here in the cement space?
I wouldn't answer that. I wouldn't be able to answer that question whether a bubble is formed or not. But if you go back, right, just 2 months or so, the fundamentals on the margin for cement stocks were improving. You had petcoke prices which had fallen 30%. You had the seasonal cement price hikes which were supposed to start from the festival season. The stocks had underperformed, and the stocks started rallying across the board. But what has happened in the last 4 to 6 weeks is purely expectations of an event. Our problem is that we look at fundamentals, we don't look at momentum. And when we look at fundamentals and we look at the capacities that are getting ready for commissioning over the next 12 months, companies who are putting money into organic capacity expansion, that's a very, very big number. So in that context, the incremental supply demand is not going to be as positive as it was in the last 18 to 24 months. So at some point of time, these expectations that the markets have need to crystallize into action for stock prices to be supported. Otherwise, there would be disappointment.
Sure. My only question, Pinakin, is that what happens to the erstwhile players, right, when such a big entrant comes into the market and pumps in so much money? I mean, Adani is looking to double its cement making capacity in the next 5 years. So what happens to names like Ultratech Cement and say something like a Shree Cement? What do you do with those stocks if you own them?
Sure. So again, I would refrain from making company-specific comments. But essentially, what happens is that in an industry where you have had a structure which has been prevalent for the better part of a decade, where select companies have gained capacity share, and now you have a new entrant who is effectively going to gain capacity share at a faster rate. That puts pressure on the incumbents. Do the incumbents match the organic capacity expansion plan? Do the incumbents go for inorganic expansion plan? So essentially, everybody would have to make decisions in terms of what do they want to do with market share, what do they want to do with capacity share. And my sense is this problem gets aggravated even further next year when a lot of brownfield capacities which started work in the last 18 to 24 months starts getting commissioned and you have incremental supply hitting the market.
Pinakin, you track the metals, mining, and of course the oil and gas space as well. So let's just shift our focus towards that. Let's address metals and mining. What's your view there, both steel and non-ferrous? What do you like and why?
Sure. So, sure, we are basically exiting the seasonal downturn that we see globally in the June, July, August period. Destocking is broadly behind us. We have seen the first steel price hikes, being announced in Europe, even in the US. Half of it is going through. The big elephant in the room is obviously as to how does China's peak construction season demand play out. It starts sometime from September, October. So far, it seems muted. On the margin, our view is that given the destocking that we have seen, steel prices, at least globally, should move higher. Not very high, but at least there should be some rebound. In non-ferrous, obviously, aluminum is going to be in focus because you have low inventories, you have hydroelectricity issues in Yunnan, there have been production cuts in aluminum, there are production cuts in Europe. So if demand stays robust and energy costs stay where they are, then non-ferrous aluminum is something to look out for, because on the margin, supply in aluminum will only reduce from here given the energy shortages that we are seeing in Europe and the hydropower situation in China.
Okay, but in that context, wouldn't Alcoa's recent warning have an impact, or do you think, of course you won't comment on individual names, but Indian aluminium players perhaps have different dynamics?
Sure. So, if what is interesting is that quite a few U.S. downstream aluminum companies have basically looked at cutting guidance. When you look at their commentary, they have highlighted cost issues, they've highlighted operational issues, but so far nobody has really spoken about demand. And as long as demand on the ground is not deteriorating, I think the focus will be on supply. So what you have in aluminum in particular is supply and demand outlook. Both are changing very fast, but the supply outlook is more immediate given the two production centers, one in Europe and one in China. And you also have seasonal restocking in demand. For aluminum, the auto production global outlook is very important, and that on the margin has improved, and that should support aluminum demand. And if aluminum demand rebounds and you still have lingering supply issues, then the only way out is for prices to go higher.
Okay. You also have coverage in the oil and gas space. You track names like ONGC, Reliance very closely. Not taking individual names, but where do your preferences lie?
So at this point of time, our global house view is that we do not know how exactly the European energy situation evolves, but essentially the entire complex of coal, gas and diesel should remain supported. So we still prefer pure refiners who are basically able to export diesel. We prefer the upstream producers in gas and coal. So we would rather be upstream or in the refiners, rather be in downstream in the energy space. Yes, I mean, we would watch out for the Chinese, fuel product export quotas. There's a lot of chatter about them increasing the quota. So far, nothing has happened. And we are still yet to hit peak demand in Europe. So anybody who exports refining products, I still think on the margin is well placed.
Pinakin, thanks a lot for joining us. Have a good summit, and we'll touch base with you later. Thanks a lot for your time today. The pre-open has settled, and just look at how the markets moved. 148 higher on the Nifty, and the Bank Nifty is opening full 1% higher, 400 points higher on the Bank Nifty. That's been the strongest component of the market. The go-to place has been at all-time high as well. So, Darshan, if we open here, do you trade the index, and what's your 9-10 call?
I would like to buy, but if we have to wait patiently for a dip or a consolidation, we can't buy at the open. And the 9-10 call is Granules is a buy with a stop under 311.
Okay, so Darshan, thanks a lot. Have a good day. Mitesh, your 9-10 call?
Yeah. So, Anuj, I'll also go with a buy call. That will be a buy on HUL with a stop around 25.54 for targets of 26.50.
Okay, well, let's do one thing. Let's talk about the NBFC space now. Just before the market opens, sources tell CNBC-TV18 that the Reserve Bank is currently not looking at allowing NBFCs to issue credit cards. Why is that? Lata has all the details. Lata, over to you.
Well, the fact of the matter is that the Reserve Bank is not considering this at the moment. Sources close to the central bank told us, and I'm quoting verbatim, this issue is not on the table right now. Now, it becomes important to clarify this because there has been market speculation that very strong NBFCs like Bajaj Finance may be allowed to issue their own credit cards. You know, at the moment, they are allowed to distribute credit cards of other banks like Bajaj Finance distributes RBL and DBS, but they distribute that only into the top metros, whereas Bajaj Finance lends in a lot of tier 2, tier 3, tier 4 companies. So if they're allowed to issue credit cards, they can really mine that depth. But it is not on the table. Now, the reason why the speculation in the minds of investors came in was because Reserve Bank issued a fresh set of master rules on credit cards on April 21st. And there, in that was a sentence, without the prior approval of the Reserve Bank, NBFCs shall not issue debit cards, credit cards, charge cards, either physically or virtually. Now, this gave the impression that with the prior approval, it is possible. However, when we asked these sources, they said it is a complete reiteration, a cut-paste of a rule that already existed, and nothing has changed, nothing fresh is on the table.
Okay, nothing fresh is on the table. Lata, thanks a lot for that. Bajaj Finance yesterday, I think there was Jeffrey's note that there will be perhaps something on the table, and the stock actually rallied. Now let's see how it reacts after the markets open. Keep in mind, today it looks like a good day for financials in general. Today is also the financial Nifty weekly options expiry. So let's see if the stock still remains strong. Mitesh, any view on Bajaj Finance? It's been very strong. How do you trade it?
Well, I actually like the stock. I think very clearly the stock, has shown signs of a consolidation after a big uptrend, and now I think is ready for a breakout. I think that will be achieved once the stock starts getting past 75.50, and I'm betting that it should happen soon.
Okay. Well, let's now focus on the market opening. The Nifty will open right at the trend line, 17,770. That was also, remember, Wednesday low, which a lot of people thought was a very crucial level to defend. The market did not that day, but looks like it will, be back at that level. On the Bank Nifty, of course, the all-time high has been 41,840 that we hit just this week itself. And after that, we saw that slip. So it will be interesting to see if we make a move back towards that. Canfin Homes, by the way, has not opened that much lower, maybe because of positioning. But we'll see how that one moves. So these are a few names. And of course, McLeod Russell and a couple of others are also doing well. The first rates are in now, and the Nifty is starting as was the indication from the SGX Nifty and the pre-open. 155 points higher, 158. The Bank Nifty 400 higher, 410 higher on the Bank Nifty. This is as strong as it gets. 50 out of 15 Nifty stocks are in the green and being led by, well, financials. IndusInd Bank is your top gainer, up 1.5%. You have ICICI Bank, which is up 1.1%. Bajaj Finance is doing well. SBI is doing well. Then, of course, you have some other stocks like Mahindra, Adani Ports, Larsen & Toubro. All these stocks doing well. Even IT is bouncing back. So Infosys is up 1.2. Tech Mahindra is doing well. Reliance is opening higher. HDFC Twins doing well. All in all, the market's holding firm, 156 points higher on the Nifty. Like I said, that there are no Nifty losers. And it's not as if the markets run away in terms of individual names. Not a single Nifty stock is up more than 1.5%. But because it's so secular in nature that almost everything is up, that's propelled the Nifty 1% higher, 160 points higher on the Nifty and 430 points higher and counting on the Bank Nifty, Sonia.
Oh, it's a terrific opening, Anuj. No two ways about that. The mid-cap index is up 370 points now. Straight off the back, it's a 1% rally. The advanced decline ratio is well in favor of advances, 2,100 stocks. I want to first talk about stocks that are hitting fresh highs. So there's Escorts Kubota that's at a fresh high, Maruti Suzuki, India Cements, Ambuja Cements, Adani Port and Solar Industries. All these stocks are sitting at fresh highs right now. Apart from that, you have moves that you're seeing in cement space, of course. Ambuja Cement, there's Nuvoco as well that's rallying up about 3-4%. Some of these retailers like Metro Brands have been doing very well last few days, so keep an eye out on that. Delivery is up, so the logistics space has been seeing some action post the logistics policy. Dish TV is up almost about 9%, big volumes being traded on that one. And some of the banks like Karur Vysya Bank, RBL Bank are trading well in the green with good volumes. On the downside, Canfin Homes expectedly is down about 4% on the resignation of Girish Kosgi. So volumes are also piling up on the downside. It's the only one that's not following the trend. Apart from that, most stocks are well in the green. Bombay Dyeing, Indiabulls Housing, Tata Motors, SAIL, Nalco, India Bulls Real Estate, all trading with healthy volume. So it's a 1% rally, and the Sensex almost a 600-point bump up.
Just another day, right?
Just another day in paradise for the Bulls.
I mean, 1% gains now. So 17,794 is where the Nifty is at, 170 points higher, looking absolutely rock solid. Dish TV, just a bunch of other names. I think most already got mentioned. Dish TV is up 8%. After yesterday's, I think yesterday was limit up. Natco is up 2.5%. Nuvoco, Sonia just mentioned. Coforge is up 3.25%. Only mentioning things with volumes. Advanced enzymes, I think Nimish reported yesterday on D Street Chatter that there was, promoters were, there was some selling from promoters or something. Yesterday, maybe that's over, 8% higher on advanced enzymes. It's coming up with large volumes as well. There's Bombay Dyeing, which is up about 3.5%. And Vandala is another one which has done very well through the course of this month. It's up another 3% today. Kesoram Industries is up 4.5%. I go down the list and, run the risk of looking at stuff with little volumes at this point. So I'll avoid. McLeod Russell was up yesterday. It's up another 10% today as well. Of course, there is news flow there, which we've reported on. Canfin Homes is the only one which is down, but just about 3.5%. Mazgaon Dock is down a little bit. Nothing, I mean, far and few in between. Defense, I've not spotted a single defense stock on the upside in the broader market, so that's a surprise. Maybe, that's been a constant feature with gains coming through very, very strongly. So that's a market for you for now. Almost 17,800, 170 points higher in the green. Our market master of the day is Hiren Vedi, CEO and Director and CIO at Alchemy Capital Management. He's joining us right now in our studios. Hiren, great to have you with us here on the program.
Thanks, Prashant.
Thank you very much, and thank you for dropping by. It's always a pleasure.
Thank you. Thank you for having me.
Hiren, how are you positioned? What's your view on the market? And because, I mean, it's been a super strong, outperforming market relative to everything else in the globe.
Yeah, and I think, we continue to remain very, very constructive on the market. We've thrown everything at this market, right, for the last 12 months. Right from rising rates to inflation, to the Ukraine war, to the energy crisis in Europe. And despite that, if the market's just shy of its all-time highs, it's telling you something, that this is more structural. And I think what's interesting for us is that the market's not very narrow like it was a couple of years ago. The breadth of the market is improving substantially. And a lot of the domestic oriented sectors are doing very well, whether it's manufacturing, capital goods, defense, you talk about it, and then banks, right? So that tells you that, India is in a great position, despite all the challenges that we are seeing around the world. And I have no doubt that our markets structurally are heading to much higher levels than where they are today.
Okay. Hiren, hi, good morning. So, that clearly is something which is worked out in the market, right? The FMCG index, auto index, bank index, all at new highs. But given the environment in the global market, do you think at some point we'll play catch up? I know we've been talking about decoupling, but the global risk off is just too pronounced and the market's just been ignoring that.
Well, Anuj, I mean, the resilience has been great. Having said that, in the short run, what we've seen in the past is that usually if there is a deep cut globally, then a catch-up happens. But I think in the medium to long term, I still believe that Indian markets will decouple from the global markets, because I think we are in a very different situation and stage, unlike in the past cycles where our macro was very, very challenged and FI flows were the predominant flows in the Indian markets. Today you now have a very robust domestic liquidity which is consistently going into the markets, right? And more importantly, I think what people miss is that I believe that we are on a structural earnings growth story in India, which got vitiated a little bit in the first quarter, and the second quarter we had not very significant, but a few downgrades because of higher raw material prices. But I think commodity prices have rolled over post that. And I think some of that, what we lost or we will lose in the first half, will likely come back in the second half of the year. And let's not forget that pre-COVID, the Nifty was at 12. Today we are at 18. We are 50% higher. But March 20, Nifty earnings was 440. March 22, which is already gone 6 months, we were at 740. Earnings were up 70%. The Nifty is up just 50%. So I think it's the other way. The Nifty needs to do a catch-up, right? And it's unless if you tell me that this year earnings are going to be negative or next year you're going to get a degrowth in earnings, which I don't believe, will happen. So I think that, why this mental block people have when Nifty is up only 50% in 2.5 years, and we've got the best earnings story in the last 2 years. So, I think Nifty needs to do a little more
rather than half empty.
So this corporate profitability to GDP ratio has gone up quite a bit, right? I mean, it's already at a decadal high of 4.3%. We haven't seen that in a while, and that just begs asking whether the Nifty EPS needs to also be scaled up higher for the next year. Are you doing that? Because a lot of brokerages have done that, and if yes, what would the contributors be?
So I think, Sonia, you mentioned a good thing. We plotted if you plot the chart of aggregate profits to GDP, right from 90 to 93, right up until now, what you'll see interesting is that we typically tend to bottom out at somewhere between 1.5 to 2% of GDP. But once we bottom out and earnings start to improve, that ratio goes up 3x from where you were at the bottom, right? So you were at 2% in March 20. You're now at 4% in 2 years. And the previous peak we saw was in 2007-8 when we went to about 7.5% of GDP. More likely the next peak will be higher than the previous peak because that's what's happened in the last few cycles. But even for argument's sake, if you take 7 as a number and you say we will achieve that 3 years down the line, and then you work backwards, you will see that earnings will grow at 20% plus, right? What happens with consensus earnings is that typically analysts tend to take quarter by quarter approach because, in the first quarter that just went by, you almost saw a 450 basis point knock on EBITDA margins YOY and 280 basis points quarter on quarter. Now, obviously, you can't take that into infinity, right? Some of that will come back because companies don't take price hikes in one go. They take it slowly over a period of time. Also, you have higher cost raw material sitting in your inventory, which needs a couple of quarters to move out. So my sense is that by the second half of the year, you will probably see upgrades starting to happen, right? And I think, autos, banks and financials, that's where the earnings growth, capital goods, that's where the earnings growth is likely to come through. So I personally feel that consensus is too bearish on earnings.
But consensus historically has been too optimistic on earnings, right? And now these are projections. Now it may happen, it may not happen.
And that's why they never get it right. Either they are too optimistic or they are too pepessimistic.
We had James Sullivan of JP Morgan with us earlier today, and this is a point we've discussed. I presented some data sometime back, essentially showing how a lot of flow is coming to India because there are other large emerging markets are not uninvestable, but they're much lesser attractive. And growth here, absolutely, macro management has been very strong. So all of that is point taken. But is it lack of alternatives where we're seeing this, almost like for the lack of a better phrase, one-time adjustment, flows coming through to India? Or is it really earnings optimism? Because the earnings optimism story we've heard for many years now. It may come through still. I'm not saying it won't. But, history says that it's better to be conservative on earnings expectations. FY24 Nifty earnings estimates were at 1,000 rupees.
More, plus 1,000 plus something, which has been cut to 950 or 960.
Yeah, right. So that's already starting to happen. The downgrades are already starting to come through. Your thoughts?
No, look, as I said, people see near-term earnings and then they pencil that in, right? My sense is that by the time you come towards the end of FY23, most likely your FY24 numbers will go back to 1,000 plus. That's my expectation. I could be wrong, right? Because I think that you can't have two things together. You can't talk about a recession in the world and commodity prices going up, right? So something has to give up. So I think some of that EBITDA margins that we lost will come back to us. Secondly, if you look at some of the lead indicators, credit growth, you look at auto numbers, right? I mean, that's all doing phenomenally well. And I think on your show, I saw the other day, I think somebody from Phoenix Mill was there and he said, look at the kind of retail.
The best ever
Diwali, festive, pre-festive shopping season that I've seen.
You can see that, right? I mean,
you can see that, right?
Yeah.
I mean, so I think, and on your point of, no other alternative to invest, I don't think that's true because up until recently, they were selling in India. And despite that, the markets went up, right? And I think we should be happy that India is a relatively better place. At least at some point in time, we got our place in the sun, where where you don't have to market India and money will come in.
Okay.
So I think we should celebrate and enjoy. However, having said that, I think we need to
avoid the hangover.
Avoid the hangover.
That's all
but
I'm
I think
saying.
there's one aspect that we shouldn't kind of take our eye off the ball, and which is that this is on the assumption that oil prices don't go back up above $100. Because I think the cushion that we built in our FX reserves, I think we've pretty much used it up trying to defend the rupee at 80, right? We're still comfortable, but we're just about comfortable.
The cover has dropped to about 9 months now.
It's now dropped to about 9 months, right? So I think that's something that we need to watch, that we've been lucky that oil prices have started to roll over and are now at $90. But if it were to go back above $100, I think that would be a bit challenging.
Okay.
So we just need to keep that in mind. But otherwise, I think we're doing absolutely fine.
Okay, fair enough. By the way, I just want to point out the stock of the day could well be SBI Card. Just look at that move, 4% higher on that. Of course, for last couple of days, it was under pressure because of the chatter that NBFCs will be allowed to, get into the credit card business. Now, Lata's story, and she's saying that she got it from really impeccable sources, is that RBI is not looking at it anytime in the near future. And the stock has underperformed in a market where most of the financial stocks have done well. So that's why you're seeing this move 4% higher on that. Now, you're launching a new Category 3 AIF, right, Hiren? Why don't you tell us about that? You're going to choose 20 to 25 stocks. What kind of sectors, what kind of allocation will you have for individual names?
So, yeah, I mean, up until now, we've always run a multi-cap strategy. Right. We're now doing a specific small and mid-cap strategy called Emerging Leaders of Tomorrow. And we believe that the time is right for a dedicated small and mid-cap strategy. I just mentioned early on to Prashant that how we've seen the breadth of economic growth improve, right? So if you look at 2018-19, they were very difficult years for small and mid-caps. And we had such a narrow market, with only the top 15, 20 companies doing very well. And I think for a long time, one theme which has been running through, which is of consolidation, the big getting bigger, the organized players taking away market share from the unorganized player. And I think that trend is well understood, well invested, and will continue. I'm not saying that's going to go. But underlying, there is another trend which I think is going to start, and which is that you will have a lot of young sectors which will become big, right? Because I think in India, manufacturing is coming out after a 10-year slumber, right? So we've not seen absolute profits scale the peaks that we saw 8-10 years ago in many sectors, whether it is capital goods, manufacturing. And I think post-COVID, in the new geopolitical situation with more and more Indian companies plugging into global supply chains and the focus on Atmanirbhar. There is a lot of dynamism in a lot of new sectors like new energy and renewables, in electric vehicles, in defense, right? When the auto industry became big in India, when Suzuki and Hyundai came, they created a whole ecosystem of auto component manufacturers. I think now we will see something like this happen in defense and in electric vehicles, where there will be a whole ecosystem of smaller engineering companies and service companies and software companies which are plugging into the supply chain, being ancillaries to the big boys in those sectors. So I think there's going to be a lot of fresh blood, fresh dynamism, new entrepreneurs, new industries which will come up.
Actually, on that note, I just wanted to ask you, if there was a report that Jeffries had put out, and we got the strategist a couple of days ago, who said that India has the largest population of Gen Z in the world, right?
Yeah.
The 20 to 30-year-olds. And it's now exceeded China by 1.5 times. And they're the guys who are going to, of course, do all the spending as we move into the next decade.
Exactly.
So what do you see as the disruption?
But they don't want to spend, right? they don't want to work. They don't buy a house. They don't want to, terrible.
They don't want to work, but they want to spend, right? Go ahead. What do you see
They don't want to work, they want to borrow on BNPL and spend.
And almost everyone's coming and saying that manufacturing is going to be the big bet.
Yeah.
I think I met 2 or 3 big investors, and almost everyone is going all in on manufacturing. Is that a risk then? Too much of a consensus?
Yeah, I mean, look, everybody says that, but let's see how many follow through and stay invested for the next couple of years. I think it is a real trend. It is a long-term trend for sure. That doesn't mean that there are no opportunities outside of manufacturing. I think the reason why we say manufacturing is because it was a lost decade for manufacturing, pretty much, right? And I think now manufacturing is coming back. And to your point, Sonia, I think, it's like this. Like 5 years ago, there was only one QSR company, right? Westlife, McDonald's, and then came Domino's, and now you have a bunch of 7, 8 of them, right? So I think there are many these new sectors which are coming up, and the only way to play is because you don't have large caps in those sectors. So you should start with small and mid-sized companies. Hopefully some of them will become large cap, right? Just like it happened many years ago in NBFCs, and then some NBFCs became big, or generic pharmaceuticals in the 90s, which then became multi-billion-dollar businesses, or specialty chemicals 5 years ago, which is now still in its youth and growing. So we think there's going to be a lot of dynamism, a lot of opportunities in new sectors and new leadership, right? So while the action today is all about the big groups announcing large capex programs and doing consolidation across industries, but simultaneously we think that there's going to be a lot of dynamism at the lower end of the market.
It would
as
be
well.
great hearing if you name names, but you won't. But tell us 3 group of businesses which you think, which one should kind of investigate, research, and where some of these names will emerge from.
So I think, as I mentioned, one is manufacturing, but manufacturing is a very broad term. But if I were to look at a few areas, specialty chemicals, defense, electric vehicles, I think broadly, and green energy, I think these are 3, 4 areas where you will be able to find a few manufacturing companies which will be very interesting to play. On the IT side, I think you will start, we've already said this before, that there are smaller sub-segments within the bigger IT pack, which is growing much faster, like ER&D companies, very specialized companies. I think you just have one company in data analytics. I'm sure you will see many more companies coming in data analytics, right? And the last, but the very interesting area is going to be consumption, which is either through restaurants or QSRs, travel. I think wherever there is premiumization, I think there is a big opportunity, right? I think as incomes in India go beyond $2,000, which is typically a tipping point from where discretionary consumption tends to do phenomenally well. I think there are a bunch of great specialized retailing companies, QSR companies, which could be very interesting. So I think these are some of the areas where we should be hunting.
This EV space, Hiren, is that a bit overstretched? And, especially in a country like India, where we're still struggling to get the right kind of infrastructure for the EV play.
Anuj, I think India is very innovative as a country, right? So what seems like an infrastructure bottleneck today I won't be surprised if tomorrow a small side shop has a EV charger next to him because he can make some money off it, right? So just imagine when telecom proliferated. Even a panwala used to keep a small SIM card and a recharge facility, etc., right? So I think it's a little bit of a chicken and egg. Yes, we are in the early stages, so it looks like that there is a lot of talk and very little action. But numbers tell you that if you take the total two-wheeler market and if you see how fast EVs are growing, right? It's growing at much faster rates than normal. But we have a long way to cover. So it will take time, but I think it's beginning to happen, whether in four-wheelers or in two-wheelers. And now it's also coming into transportation goods. You had Tube Investments, which launched the three-wheeler in EV. So it's not that, you know, you're going to buy something today and make money tomorrow, but it's a trend that you got to look out for.
And the entities which are coming to the market will also grow with newer listings and newer businesses in each of these sectors that you highlighted, Hiren. So that's that provides more options as well in terms of businesses. Hiren, great to have you with us here. Thank you so much for dropping by.
Thank you.
Really appreciate your time here.
Thanks a lot, Hiren. Thanks for joining in. Well, for the market, it is doing exceptionally well, no two ways about that. The Nifty is up 200 points right now, and the Sensex is up almost 700 points. Let's take it to the next guest now. Adani Transmission is the next corporate we're speaking to. In recent news, Reliance Infrastructure had filed an arbitration claim of 13,400 crores against Adani Transmission for breach of terms in a deal to sell its Mumbai power distribution business. Adani had later issued a statement rejecting the claims. To discuss the latest on this as well as the outlook, we're joined by Anil Sardana, the MD and CEO of Adani Transmission. He joins us from the sidelines of the Motilal Oswal 18th Annual Global Investor Conference. Mr. Sardana, thanks a lot for joining in. If you can first start by just giving us some clarity on this Reliance Infra claims on the Mumbai power circle.
Well, Reliance Infra is a company from which he bought the distribution business, and that was done and the transaction closed in August of 2018. Subsequently, they came back in December 2021 asking for some claim, which we said that as per the agreement is already paid for, and they then decided that they will contest it through arbitration. And as a part of that process, we also laid down our claims, and now they have laid their counterclaims. So this process will now go through, and we hope that through the due process of law, we will have an early resolution. But nothing changes as far as customers are concerned, and nothing changes as far as the regulatory regime of the Mumbai distribution system is concerned. And therefore, it is only between the shareholders that we will deal with this issue.
Okay, Mr. Dana, good morning. So let's talk about some other issues then. CAPEX, how much of it are you looking to commission in FY23 and FY24?
Perspective of bill, we will continue to invest 5,000 crore upwards each year in our ATL portfolio. And we have each year in the last 2 years, despite COVID, added actually more than that. So depending on how the opportunities come to us, we will continue to add capacities even in the days ahead. And that number hopefully will always continue to be above 5,000 crores even in the coming years.
Mr. Sardana, could you provide us with the status on collection efficiency on transmission projects, the Mumbai distribution circle?
Yeah, that's a very pertinent question, because a lot of people see tremendous amount of receivable issues in the transmission and distribution. Fortunately for us, the customers which we have in the transmission side, as also our Mumbai distribution system as well as the Mundra distribution system, we have more than 100% collection. So we have no problem of receivables, barring a few states in the transmission, those which cause delay in payment, but we get along with late payment surcharge. So for us, that's not a bad phenomena because our cost of money is far lower than the late payment surcharge that we are able to get for the delayed payment.
Okay. Also, what is your view on the upcoming tenders in the TBCB transmission projects?
As I mentioned, most of the upcoming tariff-based competitive bid projects are related to connecting the renewable power with the consumptive centers. And I guess those will continue. So I'm very bullish about the fact that in the days ahead, you will see more and more of such opportunities because the renewables during the COVID times got delayed because of various issues as we are familiar with. But now with demand rising and now with the opportunities rising, one will see a lot of renewable projects coming in the days ahead, and so would be the associated transmission lines through the tariff-based competitive bidding. So one will have a lot of opportunities.
Okay, a lot of opportunities. Mr. Sadana, what is the opportunity on green energy and also on the transmission sector with the slowing down of thermal capacities?
I guess instead of talking about the macro numbers of the fact that there is 50,000 crore worth of TBCB tenders, it will be nice to talk about the fact that our desire is to do 5,000 crore of capex each year in our ATL portfolio so that we can continue to use our internal resource generation as also make sure that our growth paradigms are sustained. And I guess we will be able to maintain that. That's important because we have to ensure that we don't increase our risk profile because our beta numbers are very low. And we will also make sure that our growth paradigms continue to be as good as they have been in the past.
Mr. Sadana, what is the blended ROE target, cost initiatives, etc., on operational assets?
You know, as of now, we achieve a very healthy rate of return, and those numbers are there for you to see in terms of our results quarter-on-quarter basis. I would only, without giving a guidance, say that we will continue to make sure that we remain healthy. And that's reflected in my commitment on 3 counts. Number 1, the risk profile reflected by the beta will continue to be low. Number 2, we will continue to be among growth. And number 3, we will make sure that our net debt to EBITDA will not exceed the number so as to impact our ratings. We will continue to be investment grade, which we are today. And it is our assurance to all the investors and our stakeholders that we will maintain that discipline.
Okay. So what are the opportunities that you're identifying in the distribution space? How can you sort of take advantage of that?
We are continuing to be very optimistic about the distribution part. We are, as I said, adding the areas around our existing distribution company. And we will make sure that we will also apply for the opportunities in other license areas in the times to come. And these times are not some long-term years. I'm talking about in the recent months you will see announcements of the fact that we will partake and apply for second licenses in some of the areas. And we will continue that spree in the subsequent quarters also.
Okay. Sir, thanks a lot for joining in and taking the time out from the conference, giving us an update on the business. That's Adani Transmission, been one of the strongest stocks in the last 12 months. Just pull up a 12-month chart and you'll see now it's almost at 4,100 and it's had a terrific ride. 124% in the last 12 months. Let's slip into a quick break. Up next, Vinti Saraf Mutreja of Vinti Organics will join in to discuss an outlook on the business. We'll also connect with Nissan Joseph of Metro Brands. The footwear sector has been on a tear. More on their business outlook in a bit.